Alright, students, moving forward with our accounting ratios, we go to the next part of it, or the last part of it, namely profitability ratios. Okay, as I have told you, the four types of ratios: liquidity, solvency, activity, profitability. Yes, these are the four types. The profitability ratios are the one which actually uses the trading profit and loss account information. Okay, so we will be using most of the trading profit and loss account information and finalizing these ratios. Because so far, whatever ratios we calculated, it was based on the balance sheet. So this ratio or these ratios are going to be based on trading profit and loss account. So let's proceed and understand what are profitability ratios, what do they do in the financial accounting or the accounting ratios category of it. The profitability ratios or financial performance is mainly summarized in income statement. That's what I told you. What are the two income statements? Trading profit and loss account. Profitability ratios are calculated to analyze the earning capacity of the business, which is the outcome of the utilization of resources employed in the business. So how will you measure the profit earned by an organization? So you would have had a lot of inputs to put in. So out of the inputs, you would have met a lot of expenses. After meeting the expenses, whatever gets left over is your profit. So there are about, 10 profitability ratios, and only 5 of them are most in common, and the other ones are to find out where exactly the business is standing today. Okay, there is a close relationship between the profit and the efficiency, which is the resources employed in the business and are utilized. The various ratios are here. What are the major resources that are employed in the business, students? You employ capital, that is money. You employ labor. Yes, you employ your land. Yes, and you employ building. What else? What else you put inside the business apart from money and human labor? You have land. You use telephone in your company. Even that is actually an input, and it is taken as an item to be calculated for the sales that is accounted to. So each of the input for every money that you spend, or even the furniture that you buy for your organization, is an input. Even a computer that you buy in your office is an input for whatever yield you're going to get. So all the inputs, so they are actually, it's nothing but capital employed. This equity share capital, preference share capital, reserves and surplus, and long-term loans. This is from the accounting perspective. But then from the real perspective, it is the chair, the table, the phone, the land, the building, the office premises, the labor, your manager, your subordinate, the marketing team, the finance team, all those laborers or employees, they are also considered as an input to come out with the output that the company creates, a product or a service or whatever it is. Okay, so now let's move on to the various profitability ratios. The first one is gross profit ratio. Now first let me read all of them, and then we will go in depth in each of them. Gross profit ratio, operating profit ratio, operating ratio, net profit ratio, return on investment or return on capital employed ratio, return on net worth ratio, and then earnings per share ratio, book value per share ratio, dividend payout ratio, and price earning ratio or PE ratio. This is also called PE ratio. Okay, these are the major ones: gross profit, operating profit, operating ratio, operating profit ratio, and net profit. All the first four are the ones, and dividend payout. These five are the ones which are most in common, but then the others are also important. Okay, so now we are going to go in depth with each of them. Gross profit ratio. Gross profit ratio is a percentage of sale, and is computed to have an idea about the gross margin. Okay, imagine your trading account. Yes, you have opening stock, you have purchases, you have wages, you have all direct expenses, carriage, inward. Then you have the sales, then you have the closing stock, and your gross profit comes here. Okay, sales amount is inclusive of the gross profit. Yes, and the gross profit is that portion of profit that is included in the sale. Okay, so it is a margin, it is a portion of the sales itself, and therefore it is, computed as gross profit is equal to sales minus cost of goods sold. Basically, this is the one that we practice. Cost of goods sold, opening stock plus purchases plus all the direct expenses minus closing stock. I'm going to give you this. This minus all of this is this. Okay, so gross profit is sales minus cost of goods sold, and cost of goods sold further is opening stock plus purchases plus direct expenses minus closing stock. Okay, so this is the formula for cost of goods sold. Got it, students? So all these are pertaining to the trading account. The items are related to the trading account. So that is what I've told you here. Okay. Gross profit is equal to sales minus cost of goods sold. Cost of goods sold is equal to opening stock plus purchases plus direct expenses minus closing stock. Okay. So gross profit ratio will be gross profit by net sales into 100. Net sales is what? Cash sales plus credit sales. Cash plus credit sales minus returns inward. Minus return inward. Okay. Or there are two words. One is returns inward, or what is the other term? Sales returns. One name is returns inwards, or it's called what? Sales returns. Okay. This is what gross profit ratio is all about. The second one is the operating profit ratio. Sorry, the operating ratio. Operating is what? What are operating expenses basically? Operating is a regular expense that you require to operate the business time and again. Okay? The expenses which are required to operate a business concern. It's called operating expenses. And operating ratio is computed on relation with sales and a few indirect expenses, which are office, admin, selling and distribution. Okay, so operating ratio is equal to cost of sales, that is cost of goods sold, plus operating expenses divided by net sales into 100. And profitability ratio, students, let me tell you, they are expressed in terms of percentage. They are expressed in terms of percentage. Okay. So operating ratio is equal to cost of sales, that is cost of goods sold, plus operating expenses divided by net sales into 100. The operating expenses are office expenses, administrative expenses, that your admin expenses, selling expenses and distribution expenses. All right. So we are done with operating ratios here. Okay, the other one. Cost on operation is determined by excluding non-operating income. We will actually look that on the operating ratio concept. It is actually a part of this. So come, let's do that. Operating profit ratio is calculated to reveal operating margin. It may be computed directly or as a residual of operating ratio. Operating profit ratio is equal to 100 minus operating ratio or operating profit by net sales into 100. Okay, where operating profit is equal to sales minus cost of operation. See, I told you cost of operation. Cost of operation will come here. Now, how will you find out the cost of operation? Operating expenses minus non-operating income will give you cost of operations. Okay, so this is how we will, we relate each of the ratios. And the non-operating income are loss on sale of asset, interest paid, dividend received, loss by fire. Students, please understand the concept of operating. The word operating means it comes in regularly every month. Okay. The director's salary or the director's remuneration is coming every month to him. So that's an operating income. Discount received is an operating income. Okay. So you'll have to understand where are we using the terminologies. Okay, so operating expenses are regular expenses and operating incomes are regular incomes. But how will you find out the cost of operation? Cost of operation will be operating expenses minus non-operating income. Okay, so that is how you find in there. So operating profit ratio is equal to operating profit by sales into 100. That is one formula, or 100 minus operating ratio. Okay, whichever is convenient, because we are doing ratios based on information available only. So when we do the problems, you will understand which formula has to be used. Now moving on to the next, it is net profit ratio. Net profit is the figure that is found from the profit and loss account. So net profit ratio is nothing but net profit divided by sales into 100. Okay, it relates sales to net profit after operational as well as non-operational income and expenditure. Operating expenses and non-operating expenses and incomes all together. Generally, net profit refers to net profit after tax, the PAT. Profit after tax is taken. It will be PAT by sales into 100. Okay. So this is done. Now going on to the next set of return on capital employed or investment ratio. Okay, it explains the overall utilization of funds by a business enterprise. Capital employed means the long-term funds employed in the business and includes shareholders' fund, debentures, and includes shareholders' funds, debentures, and long-term loans. Alternatively, capital employed may be taken as a total of non-factious assets, current liabilities. Okay, this is not factious, this is fictitious. This is fictitious, non-fictitious assets and current liabilities. Profit refers to the profit before tax and income, that is PBIT, for computation of this ratio. Thus, it is computed as profit before income, profit before interest and tax divided by capital employed into 100. See, profits that are available in the firm before interest and taxes are charged divided by capital employed. Capital employed is what? Equity share capital, preference share capital, reserves in surplus plus long-term loans. It is nothing but the net assets, we say, no? Net assets divided by the profits divided by capital employed into 100. So these formulas are based upon the items, but then only when you understand where it comes, you will be able to remember the problem or the formula. Okay. Capital employed ratio. Capital employed ratio will be profit by capital employed into 100. The profit that is taken there is the profit before income and tax, which is PBIT. Okay. The next one is return on shareholders fund. Now when we say returns, it means profit earned out of shareholders fund. So it will be profit after tax divided by shareholders. The question, the ratio's name itself tells you what will be the formula. Returns on shareholders fund. Returns is what? Profit. So it is profit earned divided by shareholders fund. Okay. Next one is earnings per share. Now earnings per share is we actually employ this much shares. What is the earning each of the share is actually giving to the organization is what is calculated here. So how will you find out EPS? It is termed as EPS. EPS is equal to profit available for equity holders divided by number of equity shares. Now, profit available to equity shareholders will be on the basis of what? Let's see. In this context, earnings refer to profit availability for equity holders, which is worked out as profit after tax minus dividend on preference share. That is PAT minus dividend on preference shares. In case if there is any dividend that is declared, when that is deducted from PAT, you get profit after tax. Profit availability to equity shareholders. So profit availability to equity shareholders divided by number of equity shareholders will give us the earnings per share ratio. Okay. And the next one is book value per share. Book value per share is also based on equity shares. So it will be equity shareholders fund divided by number of shares or number of equity shares. Equity shareholders fund is nothing but shareholders fund minus preference shares capital. See, shareholders fund is what? Equity capital plus preference capital plus reserves and surplus. Yes, this is shareholders fund. So from this, if we deduct, if we actually have to cancel this, that will be your shareholders fund, which is that will be your equity holders fund. Equity share capital plus reserves and surplus is your equity holders fund. And book value per share is equal to equity shareholders fund divided by number of shares, number of equity shares. Okay. And the last one is dividend payout ratio. Dividend payout ratio is equal to market price of a share divided by earning per share. Market price per share divided by EPS. EPS is earnings per share. EPS we learnt here. EPS is equal to profit available for equity shareholders divided by number of equity shares. And here market price will be given. EPS is profit for equity holders divided by number of equity shares. Okay. All right. So the dividend payout ratio will be market price of a share divided by earnings per share. This is on the perception of the investor. Okay. So with this, we complete our chapter, students. We just have problems to do with profitability ratios. Okay. So I hope you've got a better understanding of the, concepts that we are discussing here. And to conclude, let me use this chart to tell you each of these again, as a recap. Terms introduced in this chapter. Ratio analysis. What is ratio analysis? The analysis of the income statements and the balance sheet in terms of numerical values. Liquidity ratios. Liquidity ratios are short-term ratios which we calculate, and liquidity ratios comprises of current ratio, liquid ratio, asset test, absolute liquid ratio. Yes. Next one is solvency. Solvency is based on the investment done in the company. Okay, how solvent the company is, how sound the company is to pay off its long-term debts. The third one is the activity ratio. Activity ratio is based on the turnovers of an input to an output. The time period that is required for an input to become an output. Okay. Profitability, just now we saw. Profitability is how efficient enough the inputs are in a business. How efficient are the capitals employed, the share capitals employed. Yes, the expense, the income, all right. Return on investment. Return on investment what is our investment? It is the share capitals. And what is the amount of return we've got? How will you find the return? The profit. So there's profit divided by investment. Quick assets. Quick assets are assets which are easily convertible into cash. Okay, they are, how do you find out the formula? Liquid assets by current liabilities. Good. Equity. Equity in a company is the shareholders fund. It is equity share capital and preference share capital basically, but then both are different. Next one is return on net worth. Net worth is nothing but what? Just now we saw here. net worth. Yeah, net worth. Return on the total shareholders fund is also termed as return on net worth. Return on the shareholders fund is nothing but return on net worth. Okay. Average collection period. I told you this is based upon the accounts receivable. Yes. What is the period in which the debtors pay us in a year? Average collection period. Receivables, anything that comes inside. This is also a part of debtors turnover ratio. Turnover ratios. Turnover is the time taken from for a raw material to become a finished products. How many times turnover? Efficiency ratios are the profitability ratios. They are nothing but profitability ratios. Efficiency, profitability, all these are similar terminologies. And the last one is dividend payout. Dividend payout is basically on the earnings per share. Okay, it is on EPS. EPS is earnings per share. If we are earned huge amounts of money, then dividends are given out of them. So the dividend on, it's that excess portion of the profit that are paid off to the shareholders. It's called dividend for the money that they have invested in our company. And the payout is based on the market value of the share and the earnings of the share that we have got. Okay, so dividend payout is based on the market value of the share to the earnings of the share. Okay, students, with this, we conclude this chapter, just leaving out the problems. So in our further sessions, we'll do all the problems pertaining to the profitability ratios and a few consolidated problems. When I say consolidated, it will have all the kinds of ratios. It will have activity, it will have liquidity, it will have solvency, it will have the profitability as well. So a combination of all this will also be done in our further sessions. Yes. So hope you have enjoyed the session, because since being the concluding part, it's always happy, we are ending faster. Yes.